Good day, everyone, and welcome to this short video recording on question 10.2. We're going to focus on the C part, which is the statement of financial position. So if you read the required part, they ask you to draw up the statement of financial position of AIMA distributors as at 28 February 20.4. So this is very important because that's the end of our financial year. And they tell us that you have recently been appointed as the Assistant Financial Manager of AIMA Distributors, and it is your responsibility to compile the financial statements for the year ended 28 February 20.4. The Financial Division already compiled the pre-adjustment trial balance, and except for the additional information brought to your attention, you could not find any other mistakes in the handling of the accounting matters related to transactions and balances. So pre-adjustment trial balance implicates that we have not yet done the adjustments for the current financial year. When you read the required part, the first thing that you do is draw up a framework to start your answer off. The framework for the statement of financial position, remember, it's as at a specific date. So as at 28 February 20.4 is the basic financial accounting equation just in a statement format. So we have assets at the top and our equity and liabilities at the bottom. And then for assets, we make the distinction between non-current and current assets. So the assets that we're going to use for more than 12 months as non-current, and within the next 12 months, our current assets, and the same for liabilities. Equity cannot be distinguished between current and non-current. So from the pre-adjustment trial balance, we have to identify all the assets and liabilities. And I want you to classify these assets and liabilities as you read through the trial balance into the framework that you've drawn up. So I've included under non-current assets my property, plant and equipment. And property, plant and equipment, I cannot do a calculation in brackets over here like with all the other items. So I'm going to prepare the note for property, plant and equipment to get the amount that I'm going to include in the statement. For all my other elements in the statement of financial position, like inventories for instance, I start off with the amount given in the pre-adjustment trial balance in a bracket so that I can adjust it with the additional information. For inventories, for instance, I do not only include merchandise, I also include consumables on hand. So that will be my stationery on hand amount that I also include as inventories. For trade receivables, that is my debtors control minus my allowance for credit losses. So you need to know how we get to each amount in the statement. Other current assets, these will be other than inventories, trade receivables, and cash equivalents. Trade receivables is shown separately because it is such an important value when we do analysis of financial statements. So that's like my debtors, amounts receivable due to trading activities. Cash and cash equivalents, my bank amount, petty cash, all the money that I can get my hands on within 24 hours. Then for equity, if you only draw up a statement of financial position, that will come from the statement of changes in equity. Or alternatively, it can be your balancing amount in the statement of financial position, because remember, this is the basic accounting equation. Under my non-current liabilities, I have my long-term loan, because I will have to repay it for a longer period than 12 months. And then under current liabilities, I have trade and other payables. And I start off with my creditors control as my trade and other payables. You can see the difference here. For current assets, I had trade receivables as a separate item because I told you this is important for our analysis later. But for liabilities, we throw them all together as trade and other payables. So from the pre-adjustment trial balance, I've already earned a few marks by starting with the amounts in the framework that I've drawn up. For each additional information item, we're going to decide on the debits and credits, and then we're going to identify which part of that will influence my statement of financial position. So in number 1, the owner took stationery with a cost of 120 Rand for private use during January 20.4. No entry for this transaction was made in the records to date. So if you have a look at the pre-adjustment trial balance, they accounted for stationery in the asset account as stationery on hand. So now we're saying the owner took some of this, so I will have to decrease the asset, stationery on hand, and debit drawings. Stationery on hand is the item that we have in our statement of financial position. Remember, drawings will influence the statement of changes in equity. So I will deduct 120 Rand from the inventories amount that I started out with in the bracket. Item number 2, an EFT issued to buy inventory from Pretoria Fabrics for 7,500 was incorrectly recorded in the journals as a payment to one of the largest creditors, Pretoria Wholesalers, and was posted as such to the ledgers. That means I will have to cancel this payment because it was not a payment. So I will have to increase the creditor's control again and the specific creditor and increase my inventory with 7,500. Now both of these items will be classified as statement of financial position items. So I need to adjust the 7,500 both under inventories and for trade and other payables. In number 3, a credit note for 1,500 for goods returned to bulk buyers was received on 20 February, but no entry was made for this. So no entry will result in a debit and a credit. A credit note implies that I took back the inventory, so the inventory will decrease and my creditors will also decrease. So I have 2 entries in the statement of financial position again. So I show them as a decrease for inventory and a decrease for trade and other payables. Can you see that you are earning marks as you read through the question? In number 4, the allowance for credit losses must be adjusted to 3,008. So we first have a look at what do we have for the allowance. We only have it as 2,500. So we will need to increase the allowance on the credit side with 508, which is the difference between the 308 that we want and the 2,500 that we already have accounted for. The only item that will influence my statement of financial position is the allowance for credit losses, which is deducted from trade receivables. So can you see in my bracket, I've just added the 508 to the 2,500 to get it to add up to 3,008. A stock taking requested by the external auditors on 28 February 20.4 revealed the following. So now they tell us they saw with their eyes that inventory on hand was 61,500 and the unused stationery amounted to 1,500. They only have stationery and inventory of 65,000 and 6,520. In my statement of financial position, I will put the amounts that I saw with my eyes because I'm going to adjust for the difference in the statement of profit or loss. Please have a look at the video for the statement of profit or loss to get that influence in the other financial statement. Now they tell us that during September, we experienced cash flow problems, resulting in a loan obtained from Hillside Bank on the 1st of October 20.2. Interest at 15% per annum on the outstanding balance is payable annually on the 30th of September. Remember, payable, that's cash concept. We're not interested in cash, we're interested in accrual. So the interest rate of 15% is market related. And an amount of 14,000 was repaid to Hillside Bank on the 30th of November 20.3. Now, if you have a look at the trial balance, which was given at the end of the year, This loan amount of 86 is actually after I've already made a payment of 14,000 Rand. So when I calculate the interest, I will have to start not with 86 but with 100,000 Rand, which is the 86,000 plus the 14,000 installment that I've made. So 100,000 Rand was my loan amount from the start of the year. So until the payment on the 30th of November, I had 100,000 Rand of the bank to use for 9 months. Then it changed to 86,000 for the remaining 3 months that's left in the year. And that will give me the interest expense that I want in my books. I want the interest expense according to the accrual concept to be 14,475. In my pre-adjustment trial balance, I have an amount for interest expense of 8,750. So I need to adjust my interest expense with 5,725. I'm going to increase the expense and I'm going to credit an expense payable, which is the liability, which will influence my statement of financial position. So under my trade and other payables, I added the expense payable regarding interest on the loan. In number 7, the telephone account for February was erroneously paid twice. The account amounted to 400 Rand. So in my telephone account, I have a 400 that I do not want there. So I credit the telephone account and I debit the prepaid expense. Only the prepaid expense will be an asset. So now I have to go to my current assets section and decide where to put this 400 Rand. It's not a trade receivable, it's not inventory or cash, so it will be classified as other current assets of 400 Rand. The water and electricity account for February has not been received to date. Inquiries at the council revealed an outstanding account of 1,100 for February. It's still within my financial year. So according to the accrual concept, I will have to debit the expense and credit the expense payable. Expense payable is a liability, so that will influence my statement of financial position. In my statement of financial position, under the trade and other payables, I add another expense payable of 1,100. We received an attorney's letter during February indicating that yet penniless, a debtor owing us 550 was declared insolvent, and that a first and final dividend of 20 cents in the rand will be paid out during April. This is only in the next financial year that we will receive the payment. So the 20 cents will still remain as outstanding, but the balance of his debt should be written off. Now, if we receive 20 cents, the balance will be 80 cents. So if we take the total debt of 550, multiply it with 80%, and this will be the credit loss that we need to adjust. Now, credit losses cannot be kept in the debtor, in the asset. So I will have to credit the debtor's control and the name of the debtor and debit the credit losses. Only the debtor's control is an asset. So that 450 credit side of debtor's control will influence my statement of financial position. So I deduct it from my debtor's control amount that I started out with. Remember, this is actual credit losses, not possible credit losses like the allowance for credit losses that I have over there. The nice one, the policy of the entity regarding depreciation is for buildings 2% per annum on the straight line method, for equipment 20% per annum diminishing balance, and for vehicles straight line over the useful life. So write down the formulas for each of these methods. Straight line, which is cost minus residual times the percentage times the amount of months. Diminishing balance, cost minus accumulated depreciation times the percentage times the amount of months. And here they give us straight line without a percentage, but they give us the useful life of 6 years. So instead of taking cost minus residual times the percentage, we're just going to take the depreciable amount, which is cost minus residual, and divide it by 6 because we want the same amount, straight line, same amount for every useful life year. Now they tell us in the paragraph below, AIMA distributors decided to improve their services and therefore bought equipment for 11,500 on the 1st of May 20.3. This transaction has already been recorded. So we need to know the equipment amount that they provided to us in the pre-adjustment trial balance. The equipment amount of 66,000 already includes this 11,500. So if we do the calculation of the depreciation for equipment, we're going to have to split it into new equipment, which is the 11,500 at 20% for 10 out of the 12 months. And then go over into old equipment, which is not the 66, because remember the 66,000 was the total after the purchase of the new equipment. So this 66 minus the 11,500 is just to get the cost of the old equipment. From that cost, I need to deduct the accumulated depreciation, which is provided over here, times the percentage, and that will give me the 6,040. The building's depreciation is quite straightforward. It's just the cost times the percentage. And then for vehicles, we took the cost of 54 and divided it by the useful life years of 6. So my accounting entry, debit depreciation and credit all the accumulated depreciations. Obviously, the accumulated depreciations will be the contra assets, and they will influence the statement of financial position, but we're going to draw up the note for property, plant, and equipment using these amounts to determine the carrying value of the assets for the statement. So in the note, we start off with a carrying amount at the start of the year, which is calculated as cost minus accumulated depreciation. Then we have all our movements during the year, which is either buying, selling, or using, acquisitions, disposals, and depreciation. We use the scientific terminology. And then we get to the carrying amount at the end of the year, which is again the cost minus the accumulated depreciation. So let's complete this framework that we have with the information from the pre-adjustment trial balance. They provided us with cost prices, but it was as at the end of the year, 28 February 20.4. So all the costs you had to put in at the bottom. Because it's a pre-adjustment trial balance, the accumulated depreciation is prior to the adjustment for the current year. So all the accumulated depreciations provided in the trial balance is as at the start of the year. If we now enter all our depreciation amounts, which will also appear in the statement of profit or loss and other comprehensive income, I can now also add my acquisition for movements. Now it's a matter of adding or deducting to get to the missing values. If the cost at the end was not influenced by an acquisition, it will also have been the cost at the start. So for buildings and for land and for vehicles, can you see the costs remained unchanged? But for equipment, I had a closing balance of 66. I added 11,500. So the opening balance was only 54,500. For the accumulated depreciation, I started off with 14,000 for buildings. I had 2,280 during the year, so my accumulated depreciation at the end of the year is the opening balance plus the movement for the current year to get to the closing balance. And we'll do the same for all the other assets. Now we're not done yet because we're not interested in the asset and the contra asset separated, in the cost and the accumulated depreciation separated. So we're going to calculate the carrying amount, which is cost minus accumulated depreciation. We'll also do that at the end of the financial year. And now we can just add up to get to our total value for property, plant, and equipment. This 218,463 is the amount that we're going to transfer to our statement of change of financial position. And there we see from the note 218,463. We close all our brackets in our calculations over here, closed all the brackets, and you will see that your statement of financial position is the basic accounting equation just in a statement format, because my assets 443,490 equals equity and liabilities added together 443,490. I trust that you found this informative. We look forward to seeing you again somewhere in the cloud or watching a video.